Now, the International Monetary Fund is expressing worry about the expected slowdown of Ghana's growth rate. The fund's latest World Economic Outlook report also forecast a slowdown in economic growth across the globe. It therefore warns more challenging times for emerging economies going forward. The chief economist at the IMF, Pierre-Olivier, explained that the tightening of policy rates by central banks in the US and other developed economies will have a negative impact on emerging markets like Ghana.
About the downside risk that we're facing in the coming month and year, the financial tightening, which has been relatively orderly in its impact on especially emerging market economies up until now. There's been a lot of differentiation. Spreads have been going up. Interest rates at which countries borrow have been going up. Currencies have been depreciating. But there's still a lot of market differentiation between, for instance, commodity exporters versus commodity importers. Going forward, however, it's very clear that the tightening in the by the major central banks is going to have continued effects on the rest of the world. And we can think about basically three channels. First, there is going to be reduced demand and economic activity at the global level. That's going to weigh down on countries that rely a lot on the export sector for their growth. That's going to affect them through this channel. The tightening in the US and other central banks around the world is also leading to a major appreciation of the US dollar against emerging market currencies, and that is increasing inflation pressures in those countries. So these countries are facing higher inflation numbers because there is imported inflation. All the price of the imported goods are rising faster because they are expressed in dollars. And then there is just the fact that when we have a cycle like this, there is in general what we call a flight to safety. There is a general tendency by investors to maybe move away from emerging market economies and seek safe havens, invest in U.S. treasuries or in other safe assets around the world. We've seen the capital flows moving out of emerging markets in the last 4 or 5 months. It's been quite persistent. There's been a lot of capital outflow. As I said, it's been quite orderly until now, but it's adding pressure on domestic and sovereign rates, and that's reducing fiscal space. That's also making it harder for the private sector to also finance itself. So all of these things are going to weigh down on emerging market economies, which so far have been, as I've said, has been quite orderly. A number of emerging market economies have improved their policy frameworks, the way they implement monetary policy, the way they deploy other instruments, macroprudential instruments, to guarantee the stability of their financial sector. So things have not been too disorderly up until now. But of course, we are concerned as to whether this might continue in the future.